To you all, my name is Finn Mpofu. I lead the Startup Grind global community and partner success teams. I am based in England, albeit Startup Grind is an American company. I myself used to be a chapter director many years ago, and it's wonderful to get back to in person. So thank you to each and every one of you for making time to come along to a very special event today when we have someone from across the pond come and share their insights and their knowledge with us, Matt Conwell. So we'll give him an initial round of applause of what will be many to come. Okay, so of course, sorry, I'm skipping a little bit there. So none of this would be possible, or would not be possible, with our wonderful partners. We got David from Lewis Silkin, Oliver from, Oliver from, I don't know if anyone from Lewis Silkin is here. No, not yet, okay. So David and Oliver, Wendy from Lewis Silkin, and then of course David Deacon, from David as well from Lewis Silkin again as well. So massive thank you to our Lewis Silkin partners. Although none of them are here today, but we're thanking them essentially in spirit. So if you are, of course, looking to start, fundraise, scale, resource, they've got a fancy QR code there that you can use. They offer service, of course, called Cube, which is probably super useful for startups. So feel free to whip out your phones, scan the QR code, and you can get access to their services as well. Clearly, I'm not Peter. He's got better hair than I do, but you know, there we go. Peter Savage is the London chapter director. Many of you, if you've ever been to a Startup Grind event before, you also know Marian. Marian launched the Startup Grind London chapter. He's now based in Slovakia, but he kind of helps them from time to time. Then of course, Tim Alder as well is one of the co-directors. And then of course, you met the lovely L'Oreal in the back there. Give her a quick wave. She's one of the Startup Grind ambassadors. I don't know if Antonio, Ash, or Kane are here. James, you want to give us a wave? Oh, James is still there. See, James, we're making them work. We're certainly making them work. And a few others that we've obviously got on there. There is James' face. Okay, let's get into the main event. So we'll leave that up there, and then we can go through to main Q&A. So Mac, welcome to London. It's an absolute pleasure to have you in the city, and you, Matt, brought the sunshine as well. Can you imagine that? You need to come down to London more often.
I do. Thank you for welcoming me, and thank you to Startup Grind for putting this together. I don't know, many people probably don't know this, but I am the first and only fund Startup Grind has ever invested in.
That's very true.
Startup Grind is actually an LP in RareBreed, so this is a special event. This is actually the first Startup Grind event I've done since that, so I'm really excited for this.
Oh, you did the conference though last year. No,
it was virtual.
Okay, in person.
This is the first in person.
There you go, and it had to be London.
It had to be London.
Excellent. So, what brings you to London, Mac?
So honestly, I was supposed to speak at a conference in Ireland that got canceled, and so since I was already planning to be here, I figured I'd just hang out.
And you have been a very busy man. You all have to do is follow his Twitter feed, Mac Conwell, and he has been up to some interesting meetings, back-to-back meetings today. Yesterday, you attended a lovely VC investor dinner with some of the London meetups. Just tell us maybe a little bit about that before we dive into some of these main questions and what you think of the London VC landscape so far.
It's a thriving one. It's a thriving and growing one. My associate thinks I am a madman, so she literally put meetings back to back for 2 days for me, so I've been going nonstop, but it's been amazing getting to meet all the folks. And then last night I had the privilege of getting dinner with 25 black VCs in London. It was a pretty incredible scene, and I really enjoyed it.
Okay, good, wonderful to hear. All right, so your Twitter profile says it all. Hacker, turned hustler, turned managing partner, for RareBreed Ventures. I saw Vampire as well, which I guess must be like a night owl or something along those lines.
Pretty much.
But let's just kind of maybe go back a little bit and talk about the why you got into venture capital in the first place, and then how you went about doing it. So let's kind of go back a little bit, and maybe Matt can share a little bit of your story for those that maybe not quite acquainted to the journey.
Yeah. So, quick context. So I was a software engineer working for the government in the United States with a top secret clearance. Then I ended up founding two companies. The first one We sold the IP to a Fortune 100 company. The second one failed, so like it's like every great entrepreneur, I failed. After that, I get a job at a marketing firm that was terrible, and I quit that because they had a client I didn't agree with ethically, so like I quit on principle. Had no clue what I was going to do. That was a Friday. The very next Monday, I got an email from the investment arm of the state of Maryland saying they were hiring. And any entrepreneur who's ever pitched to a VC has probably thought to himself at some point in time, I could do that. Like, I know what a good startup looks like. I could deploy capital. I was no different. I was just as arrogant as anybody else. And so I was like, yeah, I could do this. And I literally applied to one job and one job only for them to tell me 4.5 months later that I was not qualified for that job and that they were creating a junior position and asked me if I wanted to join them on staff. And I said, absolutely. And so that's literally how I broke into venture, off of an email.
Wow.
I don't suggest that anybody else try that. Like that's a really rare thing. I didn't realize that at the time though. I just didn't know what I didn't know, right?
Right. But like, why venture in a way though? Why VC? I mean, you could have continued the founder journey. What is it about venture capital that really draws you to it?
And being a founder was hard. I told myself I was never going to do that again. So that's step one. And being in venture allows me to still be within the ecosystem, get to support founders, get to work with all kinds of companies, get to work with the smartest and most, driven people on the planet. Like, entrepreneurs are the most amazing people on the planet. Indeed. The things they are willing to do for success, the things they are willing to do for their passion and for the problems they're trying to solve, like, it's nothing like it, right? And then, like, having been a founder and being the CEO of a company, my job was to not only like pitch the company to customers, but to go to events and pitch to investors and all that. When I became a VC, they were like, yeah, we want you to go out and find entrepreneurs. I'm like, you're going to pay me to do the thing I was already doing for free? This got to be the greatest job ever. And then every now and then, I get the opportunity to give somebody money. More often than not, I tell people no. But every now and then, you get to write somebody a check. What could be better than that? So it's like, yeah, I can do this.
Love it. Any founders, entrepreneurs in the room? Show hands. Brilliant. Any VCs in the room? Okay.
If there are, they're not raising their hand.
Okay, so one of the fascinating things definitely about RareBreed Ventures is your investment thesis. Okay, so we know a lot of the time if you are a VC, it helps to have an investment thesis that you follow with conviction. And this is something that, Mac and your partners and associates have followed through and through. And one of the things I found up on your website was your 10-point manifesto, which I certainly found very fascinating to read. But I'd just love to start off with this first one, right? Which you say, you can find amazing startups anywhere in the world, right? They are amazing entrepreneurs everywhere with great ideas, building dope companies, not just in Silicon Valley, New York, Boston, and London, right? But we know London. London wasn't there. I added the London bit, but because we're of course in London. But your investment thesis is like, look, we don't have to focus on these kind of major metropolitan hubs. What is it about that you find special? And what are the untapped opportunities in almost these underrepresented markets, as it were?
I mean, I was talking about myself.
Okay.
Right, like I started my first company. I'm from Baltimore. From Baltimore, Maryland. The only thing that most people know about Baltimore is The Wire, right? I literally started a company and sold it to American Express, right? From Baltimore. Like, if I can do it, I know anybody else can. And then I spent 4 years of my life where my job was to find the best underrepresented entrepreneurs in the state of Maryland. That was literally my mandate. So I had to get really good in creative and deal sourcing. But what you find is talent's everywhere. Opportunity's not. And so if I can give that talent opportunity, well, that's the chance for me to, create a portfolio that can generate returns that looks different from a lot of the other folks around, right?
So what are some of the interesting companies that you are seeing in these underrepresented markets?
So we'll start with my hometown in Baltimore. There's a woman who created a tumble dryer that can dry a wig or hair extension in 15 minutes with no heat.
What?
Because there's no such thing as a wig dryer, right?
What?
There is 2 black women in St. Louis who created synthetic hair extensions out of plants. That's right. fake hair made out of banana leaf fibers. Not going to find that in Silicon Valley. I got a founder in Nashville, Tennessee, who has a device that can make nail polish in any color, either from a picture or a color wheel, true to form in 2 minutes right in front of you. Go in the nail salon, tell them what you want, take a picture of your shirt, get it. Not gonna find that in Silicon Valley, right? Like, I get to see and meet some of the most amazing people.
Incredible. Doing
incredible things.
Brilliant. No, listen, we love to hear it. Of course, as an investor, you are ultimately looking for outstanding returns for your fund. Typically, you know, when startups are founded, the exit journey is they're pretty much two, well, three if your company fails, but the two main exit ones are you either get acquired or merged, so an M&A, or you IPO. Can you share with me some of the opportunities with these underrepresented founders? Like, are those the typical exit strategies that we'll see happen for them to allow investors to get ROI? Or are there other undiscovered opportunities that could be present for underrepresented founders?
There probably are some other opportunities, but like, I'm a capitalist. I'm a unicorn hunter. Like, I'm only looking for unicorns. So like, it's funny. So I text with my founders all the time, and one of my founders based in Maryland has a company called Remodel Mate. You know, you go on his website, gets you a new kitchen for like half the price. And literally one day he's like, go home, or go big or go home. And then his next one was bell or bust. And so his whole thing's like, I'm either going to be a NASDAQ ringing the bell because I'm IPOing, or we're going to hit the floor. But there is no in between, because this is the goal I've set for myself. I can back a found like that every day. That's what I want. Get me that bell.
So that tenacity, that hunger, that determination, which always leads to the big question where we say, nurture versus nature, right? So do you feel founders can be taught, or they have to have that innate, like, hustler ability that until this succeeds, I am going for it, so that they can't be taught in a way?
I think there are founders that are both, right? Okay. There are founders who are taught, right? They've gotten to learn, and they've learned from family members. They've learned from, inspirations. They've learned from watching Shark Tank, right? Like there are people who go through that process. They've learned from being employees. Whenever you see a company IPO, you always see a bunch of people who used to work at that company start companies, right? Like, that is a thing. And then there are people who they're just built for this. This is what they couldn't do anything else because they're horrible employees. Like, they couldn't work for anybody else. So they have to do it. They have to make it happen, right? Where, like, the tenacity that carries them through. I mean, look, this woman who's making this wig dryer, after she couldn't get funding for 3 years and got nothing but no's, she became a surrogate mother to raise the capital to start building her prototype. Like, she literally gave birth to twins for the money to start building her prototype. That's insane. But there is no way she's gonna let her company fail. Like, when she says, I will do anything to make this company fail, I believe her. like I am going to listen to her every time. And so you have founders like that, right? But I don't think there's any one archetype of a founder, right? Founders come in so many different shapes, sizes, backgrounds, mindsets. I'm here to back them all. Yeah, that's really what I want to do. I want to invest in the best founders building the best companies, point blank. I don't care who you are. I don't care where you come from. I don't care what you look like. I care about, can you do this? And if you can, let's make some money together.
Oh, love that. Now, of course, running a VC is much like, being a founder. You had to raise capital, and your story is quite fascinating on that. I mean, I know you mentioned a startup growing. We're an LP in RareBreed Ventures, but talk to us about your journey raising your initial fund and some of the steps you took to make it happen.
So I raised my fund on Twitter. 80% of my LPs came from a Twitter interaction. And so what happened was, during COVID, I started tweeting, and As I started tweeting, I met a founder in Dallas building a company called RareBreed that I wanted to back. So I was like, I'm gonna put a special purpose vehicle, do a one-off investment and help you out. As I was doing it, one of my advisors said, I don't want to invest in this company. I want to invest in every company you find. So here's $250, go raise a fund. Awesome, now what? He's like, go figure it out. And so like, I recognized very quickly, I didn't know what I was doing or how to raise a fund. But I noticed VCs started following me on Twitter. So I'm like, okay, let me start reaching out to these folks who are following me on Twitter just so I can learn from them. And within like my first 20 conversations, I meet this amazing woman named Elizabeth Yin from Hustle Fund. And at the end of our first 30-minute meeting, she asked me what my minimum check size for my fund was, and I said 10K, and she said I could do that. And I was like, what? I'm like, don't you run your own fund? She's like, yeah, but I can do this out of my personal money. I was like, oh, you can do that? She's like, yeah. I was like, oh, well, now there's a strategy that's emerged. Let's keep tweeting. The more I tweet, the more VCs I meet, the more VCs I meet, the more money I might raise. And so from middle of June 2020 to the middle of September 2020, I had 1,128 meetings. And that soft circled my first 3 million.
Wow.
Don't do that.
Aside from don't do that, but what was the greatest lesson you learned from that process?
There's always a way.
Okay.
There's always a way, right? Like, I broke just about every rule you could break trying to raise a fund. Like, I didn't have any money in my bank account when I did this. I didn't have any real connections. I had a strong skill set, a little bit of track record. And I was just like, yeah, I'll figure it out somehow, like as I go. And I was able to figure it out. You know, I did a lot of things that people told me couldn't be done or shouldn't be done. And I did them. And so like, there's always a way. And everybody has to find their own way.
Yeah.
I think too many people try to follow other people's paths instead of trying to figure out what their own is. And so throughout the process, I figured out what my path was.
Love that. Let's talk about innovation in VC, in the VC landscape space, and some of the trends that you are seeing. So you touched on special purpose vehicles, so SPVs, but are there any other interesting things that you are seeing as a venture capitalist on how either funds are raising capital and or deploying that capital as well, and even maybe offering returns to their LPs?
I mean, what we're seeing in the market is, you know, there are different types of funds coming out now. You know, Sequoia's got their long-term late-stage fund that they do. You know, they lock their LPs' money up for like 20, 30 years, and they're good for it. You got AngelList, who has popularized rolling funds. So these are the kind of funds that have been around for a long time, where you're literally raising a new fund every quarter, kind of a thing. We're seeing a proliferation of people who don't have the capital or the network to be VCs themselves, starting angel syndicates and using those syndicates where they source deals and share them with, you know, high net worth individuals for them to make investments themselves, and use that to create their own track record, so then they can spin out and then create a fund. You know, we're seeing a lot of that. We're also seeing the growth in secondaries. You know, Carta has launched Carta X, so now it's making it easier for private companies and people who work at private companies to start selling shares sooner. And even for VCs to start selling our ownership in companies sooner. So instead of waiting, you know, however long it takes for a company IPO, you might have been in the company for 5 years and you got a 50x return on it. Go get your money. You can do that now. So, you know, we're seeing more and more of these things. And then we're also seeing a lot of, you know, there's always been these like preemptive rounds where while you're building your company, you're not even thinking about raising, and you just took a meeting with an investor because you like has something to do, and then they give you a term sheet. That's happening like all the time now. Like founders aren't even going to raise. They're just like, hey, by the way, somebody wanted to give me money. You want to join? It's like, that was not planned.
Right.
But it's great for founders. Like folks are raising money faster and easier than ever before. But let me just caveat that faster and easier than ever before is still one of the hardest things you'll ever do. So like, raising money is one of the hardest things you will ever do. It's just a little bit easier than it was, like, let's say 10 years ago.
Yep. Okay. You touched on term sheets there, and I'd love to just delve into that a little bit with your VC hat on, right? Which is, yes, you mentioned you want tenacity, can-do attitude, never die. But what are 2 or 3 other things you look at as a VC hat on before you kind of issue that term sheet?
Are you in a big enough market to support a $1 billion company? Like, I got to start there. Like, if you don't have the potential to be a $1 billion company, like, it's just a non-starter, right? It's just, VC is built on the power law, which basically just means your fund is only as good as your best exiting company. 100%. So that means every company you invest in has got to have the potential to be that. Next is, for me, I care a lot about the way you go about customer acquisition. I don't really care as much about your product, right? Like, product's cool, you're probably smart, you can figure that part out. But can you actually get that product in the hands of people who are going to pay for it and keep coming back? Like, if you can't do that, I don't care how great your product is. And that's just from experience of having been in this space where I've met founders who have created products that are far superior than anything on the market. We're like, I'm happy to be your first customer. And then they never go anywhere because they don't figure out how to sell it. I want to know if you know how to get it in the hands of folks. And you know what the greatest example of this? It's the iPod. The iPod literally saved Apple. But the first version of the iPod was nothing but a crappy MP3 player. Them things broke all the time. Like, you could go to like a store like a Best Buy or, Circuit Cities or whatever, or wherever you go to buy, electronics, and they would have a literal wall of MP3 players. Most of them cheaper and better than the iPod. And people will walk past that wall to go get the more expensive iPod every time because they figured out the psyche of their customers and the branding. And that gave them enough runway to actually build a superior product. It didn't start off that way though. They started off with the distribution. So, I'm always digging in on customer acquisition. And then I'm looking for proxies for your ability to execute. And very often that's going to be traction, right? How many customers do you have? How's your revenue going? And it's not how much, it's how much are you growing by? Like, what's your growth rate? That's really a proxy for execution. Do your is it something where like customers love you? Like, if I take a customer call and they're like, I could not live without this company. Like, I would stop giving my team, pizza every Friday if that meant I could keep this. But if I have a company tell me that, I'm investing every time. Like, if you tell me you're going to give up like luxuries to keep this, you've got some. And so like, I'm always looking for these proxies of like, do you really got it or not?
Yeah.
And those come in all kinds of forms.
Okay. All right. VC turnoffs. Right? What are the things that put you off founders when they are pitching for funding from your fund?
We're going to be $1 billion company in 3 years. No, you're not. You got to get in now. The deal's going really fast. You only got a couple days. Oh, okay. I've seen how that goes before. Things like that. Oh, you don't want to invest in me. I thought you actually cared about underrepresented founders. Why won't you give me money? Well, I can't just give you money because you're underrepresented. You got to have the business.
Yep.
Like that. These things go hand in hand. Things like that. And also, don't lie to me. Don't send me a deck that has one of my friends on it as an advisor, and I call them and they say they don't know you. That's a quick way to kill a deal. Don't tell me that you're doing X amount of revenue and I ask you for your bank statement and you get really quiet. Like, send me your P&L, I want to see it. It's funny when you see founders get real quiet when you start asking for stuff like that. Yeah. You don't need to lie. Anything bigger than zero is better than like 80% of all startups ever, right? Like, if you're not there yet, that's okay. And if I tell you you're not there yet, that doesn't mean that you can't get there. And if I don't tell you no, and I tell you you're not there yet, that's not me being polite to push you off. That's me having the fundamental belief that you have the potential to do better in the future. I'm not going to tell you no now and you never want to talk to me again. I'm going to tell you you're not there yet. Come back. Because I have a fundamental belief in entrepreneurs that maybe in 6 months you'll be there. Maybe in a year you've done something different. If I just tell you no, that means I fundamentally don't believe you can do anything else than what you're doing now. I'm never going to do that.
Love that. Okay, there's been, NFTs, crypto, blockchain, DAOs, you name it. Okay, Web3 is a hot topic. Very, very hot topic. We did Web3 month of startup grind. Probably one of our highest attended months globally for all the events that happened. I think it was like 100 plus events that happened, all Web3 related. Close to nearly 10,000 attendees all around the world. Just some really fascinating conversations happening around that. Where do you see the biggest opportunity when we look at all the umbrella themes that come under Web3 from a venture capital perspective, first off, and then secondly, perhaps from underrepresented founders are probably missing some opportunities with Web3 where it's creating a level playing field, as it were. Are you seeing that as well? So, first from a VC perspective, and then maybe, some insights or trends you're seeing or tips for underrepresented founders.
I think what people need to understand is that Web3 is still in its infancy. So we don't actually know what is going to be fully built out. So from a VC's perspective, and this is just one man's opinion, I think the places, the verticals right now that are really interesting for me is fintech, because that was the first one to really pick up, because everybody understands cryptocurrencies, right? And the other one is in the underlying infrastructure of Web3, right? We have all these different coins and tokens out there. How do they interact? How do they work together? How do you manage all these different pieces? You got people coming out with DAOs. Well, if you got a DAO with 1 million people, how you handle governance? How you handle votes? How do you handle having whales, where even though you got 1 million people, it's still controlled by 5? But that kind of reminds you like something we already have. That feels like classism. This thing's kind of, that doesn't feel good. How do we fix those kind of things? There are going to be technologies that are going to be built to support and handle those things that are going to be really interesting. They're going to be very foundational. And when you invest in a company that's going to be foundational, you can get somewhere for a long, long time. And so those are the things that are interesting for me. And when you think about underrepresented founders, Web3's leveled the playing field because you don't already have an inherent good old boys network, right? It's all new, it's all fresh. The problem is, the way good old boy networks are built is access to information.
Yep.
So there's still a ton of underrepresented founders who are in communities where they're not sharing information about Web3 or talking about it. If you're not spending time on Discord and checking out these new projects and understanding the difference between being doxed and undoxed and all these little nuances, you're missing out. But then who told you to get on Discord, right? Jay-Z's not telling you to get on Discord, right? Jay-Z's telling you to invest money. He's telling you to think about venture capital. So is Serena Williams. That's amazing. That's in pop culture. People are talking about it. They're not talking about Web3 or Discord, right? They say blockchain, but they're not talking about what it is, right? So then where do you get that information from? You have to know to look for it. But who tells you to look for it? I know to look for it because somebody else told me I need to get into it. Well, if that's not the circle you're in, you're behind.
Yep.
So that means by the time you get in, a new good old boys network has been built.
And whilst it's in its infancy, and there's the natural risk of saying, because it's in its infancy, more things go wrong than go right, right? Or there are more scam artists, etc. What are some of the cautionary things just people should look for generally, whether you're a founder looking to build something, or maybe even if you're an investor looking to put some money behind a Web3 project? Some of the cautionary things you would look at that I guess you can borrow from the VC worldscape, knowing that this is something that it's in its infancy. So maybe they don't have all the metrics. They don't have a well-defined, massive billion-dollar market.
First and foremost, if you are anonymous, I am not investing. Like, I need to know who's taking my money. Like, there's a bunch of developers of these Web3 projects who are like, yeah, we're anonymous. Like, no. I cannot go to my investors and tell them, yeah, I gave money to somebody, but I don't know who they are. Like, so what happens if anything happens? I don't know. Can't really take them to court, right? Like, that is never going to fly. Make sure you have a clear understanding of how you're going to take custody of tokens and what that means. And even if you're an investor, and even an entrepreneur who's not doing it yet, you're not in the Web3 yet, you never know when one of your partners, one of your vendors switches over, and you gotta scramble real quick to understand all this stuff. You know, I employ everybody, get yourself a crypto wallet. Start learning how it works. It's a really arduous process. Learn about gas fees. Every time you do a transaction, you gotta pay an additional transaction fee. And those transaction fees can get really large. Like, the first time I paid gas fees, I'm like, what is this for? Like,
the value of the item.
We supposed to be just, sending coins back and forth. Why am I paying extra money to send the coin?
Yeah.
Like, this is worse than the ATM, right? Make sure founders understand tokenomics, right? And so basically, as they're deploying tokens, how many tokens can they deploy and what do they represent? And what does that mean over the long haul? I've met, projects, they're like, yeah, we're gonna deploy this many tokens. But once you do the math, after 6 years, they're out of tokens.
Yep.
And then the project starts to feed on itself. It very quickly loses a lot of value. But I wouldn't know that if I, hadn't been told, somebody else told me to look up tokenomics.
Yep.
And then for me to do the math about it, right? So those are things you gotta really look out for. And then just generally, there's always scam artists out there. But that's whether you're doing Web3 or anything else. Everybody's seeing Theranos,
Yeah. Okay, so last question from me, and then we'll switch to Q&A, because I'm sure, in addition to the in-person audience here, we're going hybrid. We got virtual audience as well. Big vision for RareBreed Ventures. Where would you like to take the VC fund?
The next Sequoia, the next Andreessen, the next NEA, the next top-tier, large, multi-stage firm. It's just going to be based out of Baltimore. That's the big vision.
Nice.
It's been the vision since day one. I'm putting in all the work and effort to make it happen. So I'll see y'all at the top. Don't worry.
All right, we're going to switch now to some Q&A. Matt, you can remain there. Okay, so if you head over to Slido, I don't know if someone's got access to the Slido from the team. Perfect. All right, why don't you come on up and you can handle Q&A for us.
So one question says, how long did it take to raise your fund? And how many LP calls do you have? And what was the hardest part of your fundraising? So 3 questions.
It took me 13.
That's efficient Q&A person there.
It took me 13 months to raise Fund 1. I had well over 3,000 LP pitches. The hardest thing about it was early on not having a network of LPs to go to. And that's why I use Twitter, because I didn't have a network. And whether you're an investor or an entrepreneur, early on in your fundraising journey, pre-seed or seed, 80% of it is network. And when you don't have a network, then you got to put in the effort and build one. Whether that's a network of high net worths or VCs or what have you. And when you do that organically, it takes a really long time. I was lucky that I was able to do it on Twitter, so it didn't take nearly as long. But the name of the game, man, you got to go through as many meetups, coffees, virtual events, LinkedIn posts, cold emails, whatever, to just meet somebody who introduces you to somebody else, who introduces you to somebody else, to introduce you to somebody who's willing to write you a check. Whether that takes you 2 weeks or 2 years, it's a process.
We'll take a question, maybe audience in the room first before we go to Slido, or are they all coming via Slido?
We have quite a few from Slido.
Okay, we'll try and rotate to keep it equitable as much as possible. Yeah, one for Gary, go ahead.
Yeah, no, thanks for that. So my question is, how do you analyze industries that aren't already kind of like hyped? So like Web3, everyone's talking about it, but let's say synthetic hair or wig dryers, those are kind of a bit more, not typical. So how do you analyze those and come to conviction that those are going to be billion-dollar markets?
Well, one, you start with the market size, and like the wig and hair extension market's a $6 billion market. Okay, hasn't had innovation in drying or in the materials we use for the hair in our lifetime. Okay, there's opportunity. And then at the end of the day, I don't care about what vertical you're in or anything like that. I care about basic business fundamentals, right? Are you in a large market? Are you solving a real problem? Are people willing to pay for it? And will they come back? If you can tell me those 4 things, you probably have a chance to be successful, right? Like literally, like those 4 basic things. Doesn't matter what your business is. Doesn't matter what your vertical is. You can answer those 4 things. We got a shot to do something. And so that's how I do it. Like, it doesn't have to be a hype vertical. It just has to be a good business. My job is to take money from other people and make them more money by investing in private companies. So I gotta give money to somebody that thinks gonna make us more money. And if you can show me like, hey, solve a real problem, people love my product, and they keep coming back, something there.
Okay, there's a question from Mirav, and they ask, what do you think about the warm intro model and its impact on underrepresented founders?
It sucks, right? Because like, what the warm intro model means, what it means is that it's not about how do you meet an investor. It's about how do you meet somebody who's willing to introduce you to an investor. Like, yo, how the hell are you supposed to figure that out? I remember the first time I heard that, I was like, so I don't need to find investors, I need to find people who know investors. Like, do people just like wear a badge that says, hi, I know an investor? Like how are you supposed to figure that out? And really that just means you gotta network and you gotta meet people. But if you're underrepresented, you're not from communities, like when I started my first company in 2010, I didn't know what networking was. Like, I'll never forget when I first started going to events. I was doing it all in Baltimore, and I had this guy come up to me. He's like, man, you've been networking a lot recently. I was like, I don't run wires. Like, what are you talking about? Like, I was so confused, right? And like, I had to figure it out. But it took me literally like 2.5 years to figure out how all this stuff really worked. Imagine if I had that knowledge day one, how much further I would have gotten, right? And we see this happen to underrepresented founders time and time again. And warm intros is just another proliferation of it, right? So they suck. But I also get it because like, if you don't take warm intros, you're gonna get like 1 million emails every day from every entrepreneur. It's like, hey, I got an idea. And like, I'm not gonna be able to read all those. But granted, I get a bunch of emails. I get like 10 to 20 emails a day from founders. I try to get to as many of them as I can, right? Like, I'm not perfect, but I've invested off a cold email or a cold tweet or cold DM, like it happens. And that's all it is. I'm leaving the opportunity open for it to happen. And more investors need to.
Go ahead.
I'm going to kind of steal your answer, Mac, for the next question, which is about cold emails. Is there anything in common from the ones you've answered that are quite good to include?
Oh, great. So if you're going to send me a cold email, give me like 2 to 3 sentences about what you do, and then give me 3 bullet points about how you're doing it. Like, things that are going to get me excited. Typically traction. Like, we launched on this date, we have X amount of customers, and we've been growing by 28% month over month. Okay, let's have a meeting, right? Don't give me a 4-page letter about everything you ever done in your life and how you're going to change the world. Like, I don't have the time to read it. It's probably really great. It's probably really informative, and I might actually like your company. I literally don't have the time to read this. Help me help you, please. Give me some bullet points and some key metrics and give me a quick blurb about what you do. And if you're in an oversaturated space and you're gonna be mad that I'm gonna call it oversaturated space, whatever, definitely hit the metrics and tell me why you're different. Like, if you're in this travel, start off telling me, well, this is not like all the other travel companies, is going to be better, and then give me the metrics to support that. Because I'm gonna tell you real quick, I'm not interested. There's 1 million of y'all. I have no clue how to pick the winner. I know my limitations.
Any other? Okay, brilliant.
Oh, no, we have more.
Oh, sorry.
Shall I just do the first one?
Yeah, go ahead.
So you mentioned vehicles to sell shares, allowing VCs to exit. How do we accurately determine the price point in real time of these early stage ventures?
Well, it's typically not happening at early stage, right? Like when you're talking about secondaries, they're usually later stage companies, and the valuations are usually based on the last valuation of the last round they had, right? And most times when VCs are going to sell their shares in the secondaries, it's usually during a round anyway. Like that usually happens while you're raising capital. So when somebody new comes in, they can buy it from me and instead of necessarily always from the founders, right? They can just take my stuff. And so that's how it's done. And there's no real like accuracy to it. If you know anything about valuations, it's a lot more art than it is science. That's the other thing. Don't come to me and tell me why your valuation needs to be something because of your numbers or whatever. Like, that's not how this works. Like, don't talk to me about your EBITDA. I don't care enough about that. Like, it's about how much money are you raising, how much equity do I want to own. Like, if you're raising $1 million and I want to own 20% equity, all right, we're starting with a $5 million valuation. And then the leverage is what dictates whether it goes up or down from there. And the leverage could be the market, and like you say, hey, that's not market rate. The leverage could be, hey, I got like 5 other VCs who say they're going to do this and they're willing to give me, better terms. But more often than not, it's going to be me like, hey, I'm willing to write you a check. I don't see anybody else doing it. You want the million or not? I guess that's how valuations actually work. It's kind of crappy for founders. I'm sorry.
Yes, please go ahead.
So what do you think is the hardest thing about, what is the biggest disadvantage of underestimating founders? And how does part of it have to do with psychology?
What was the second part of that question?
What is the hardest thing about being an underestimated founder, and does some of it have to do with psychology?
Yes, absolutely. It all has to do with psychology. One of the hardest things about being an underrepresented founder when raising money is very often the inability of the investor you're talking to look at you subjectively, right? It's one thing when they look at somebody who went to the same school as them, or reminds them of their best friend growing up, or reminds them of their cousin, or like has a similar, like they can be like, oh, it's not perfect, but no, I see something, like I feel it, like there's something about them. So they remind them of somebody. When you don't come from the same background, you don't look like them, you don't look like a cousin, then it's like, okay, tell me about your numbers, what are your metrics, how you doing, how you growing? Because they can only be objective at that point. I mean, that's a real disadvantage. And there's nothing you can do, there's literally nothing you can do about it. Other than show up and just say, I'm growing so fast, I don't need your money. Do you want to give me money? If not, I'm gonna just keep growing really fast. Yes, please take my money, right? Like that's how that works.
Back to you.
One says, Mac, you're awesome. How did you make your LPs believe in you and invest in your fund?
I tell really great stories, but like, that's not even a joke. Like that's really how I got them to believe. I tell really good stories. And by the end of it, they will walk away with a feeling of like, maybe you can do this. And I'd be like, yes, I absolutely can. That is really how, it's like, and this is something that all entrepreneurs need to learn. The art of pitching is the art of storytelling. Learn how to tell the story of what you're doing in a human way. Because if it impacts me and it draws me in, now I'm excited to learn more, right? It doesn't mean that when I go to learn more that you hit all the notes you need to hit, right? But if you can get really good at storytelling, you can definitely draw people in. And you can give yourself a real advantage. And so for me, that was my big advantage. I'm a good storyteller. And I learned what the story was that I needed to tell to get people to want to open up their checkbooks. And that made all the difference in the world. This little lady, I know you've been keeping.
Oh, thank you. So do you invest in founders pre-traction? And if you do, what would convince you to do that?
So this is a great question, right? Because I'm sure all of y'all have seen these early stage VCs who say we invest as early as possible, pre-traction, pre-revenue, and then you go to pitch them, they're like, well, you don't have enough traction. And you're like, what the hell, right? Here's the thing. All of us early stage VCs say that, to cover our butts, to cover all the exceptions. Do I invest pre-product, pre-traction? Yes, but very, very rarely, in very unique situations. More often than not, I'm going to be looking for traction, right? But if I didn't say that I invested that early, then I would never get to see those exceptions, right? Just understand, like, exceptions mean like there's a very limited number of those. So what would get me to like invest pre-traction? If the COO of Tom Brady's new NFT company calls me, it's like, hey, we have an engineer that's been helping us with an underlying protocol to make this better. We think it should be a product though. Would you be interested in investing in that product if we decide to spin that out? Yeah, sure, we could do that. Or if you tell me, hey, I'm building this wig dryer, because there is no such thing as a wig dryer, and because nobody would give me money, I literally gave birth to twins to start funding my idea. Yeah, you're going to make it happen. I'll give you some money. Outside of that, it gets really tough, right? So like, do I do it? Yeah. Do I do it often? Not at all. It ain't core to what I do. So, and for most early stage funds that say that, it ain't core to what they do either. Like just don't believe the hype. It'll save you a lot of heartache, I promise.
Okay, so what is the percentage of investments going to underrepresented founders in the UK and USA?
What was the question?
What's the percentage of investments going to underrepresented founders, if you know? Like,
it's about the same. It's like underrepresented as a whole is probably like 4 or 5%. Like the percentage hasn't changed, right? The amount of dollars has changed, but the percentage hasn't, right? If you're going to ask me about my fund, 70% of my fund is underrepresented founders. But you know, that's me. And I don't have a mandate to invest in underrepresented founders. Like, that's not part of our thesis. It's just, you know, I find really cool companies that just happen to be made by like people of color and women. Go figure. Who knew?
How did your investment thesis evolve since your first investment?
My investment thesis evolved really from the time I started working at the state of Maryland. And so the way I created my investment thesis was I got to see like which founders were doing the best out of my previous fund and which ones weren't. And what were the kind of companies I liked investing in and which kind of companies I didn't like investing in. And that became my thesis. I like literally backed into it because I was like, hey, I hate the way y'all guys invest. I can do it differently and better. And I just built that over time.
Okay.
Are we getting kicked out?
How you wrap?
We got like,
yeah, I was going to say, sure. We'll take maybe the last two in person, and then we'll kind of just do a wrap if that's okay. So we'll go 1, and then, okay, 3. 1, 2, 3, and then we'll wrap if that's okay.
Nobody from this side wanted to ask me a question. What's going on? This side of the house don't like me? All right, cool. Go ahead.
Can you talk about your sourcing model, like how you find these companies? Is it global or you're obviously based in the US?
North America, South America, and UK. But I do get like global deals, but like I stick to what I can do.
You haven't done Africa?
Not yet. It's going to be a little while before I get to Africa.
But do you have a model to go and look at these companies, or is it whatever you see and you find the best companies doing that?
Whatever I see, find the best companies. Ain't no models. Just like, is it a good company or not? Do I think you could be a unicorn or not? If I don't think you can, keep it moving. If I do, here's a check. Like, I make it sound really simple, but that's like really how it is.
Is it easier to raise funds in the US versus the UK? If so, where?
It's not so much that it's easier as much as it is there's so much more capital. So the chances of you running into somebody who's going to invest in your company is just different, right? Like in the US, you could literally have 2 weeks where you meet 40 investors. I don't know if you can do that in the UK, right? Like, so it's just the opportunity set's larger. It doesn't make it easier. It just means there's more opportunity. Last one.
Just wondering, how long does it normally take you to do due diligence? And if I want to pitch to you, how do I send my pitch to you?
They say that. Now we like that energy, though. I mean,
You want to pitch me, tweet at me, or send me a DM. How long does it take me to do due diligence? Fastest I've ever done is 2 days. Longest, 4 weeks. All depends.
I'll send feedback.
We got one last one. All right, come on, last one.
It sounds like a Twitter was your hack into your network to raise your fund.
Absolutely.
If you're a founder today that's not on Twitter and just starting out with nobody there, getting started on LinkedIn, how would you approach trying to hack your way into new networks?
If you're a founder on LinkedIn, or anywhere, you want to peg yourself as a subject matter expert. You want to be the person everybody knows for something, whatever that thing is. Because now people want to get to know you. And now people are going to vouch for you because of the information and knowledge they think you have. That becomes a much easier way for you to get into other networks, and becomes an easier way for people to be like, I might not know you as well, but I'm willing to make an introduction because I know you're smart, because I've read your material and I've seen what you say, and I see what. That's probably the easiest hack. All right.
Ladies and gentlemen, let's give it up for Mac. Okay, so what we're going to do is, if I can get maybe the London team to come over, we can grab the picture with the London team, and then we'll open up for a little bit of networking. Mac does need to get on a train, so if we can just be super mindful and cognizant of that when he's shooting out that door. Go, Deck, if you can grab the picture for me, please, that would be great. There we go. And all smiles.
Okay.
Brilliant.
Awesome.
Okay.
Thank you.
Again, thank you, Mac, so much. Really appreciate it. If you are not able to travel to Silicon Valley for our London Startup Grind Global Conference that is taking place April 12th to 13th, it is going to be live streamed. Live stream will be opening about a week before, so I think it's the 5th of April, if I'm not mistaken. But if you can make it out to Silicon Valley, we would love to have you there in person. It's going to be mega. Come and see me. I'm sure I can sort out some comp tickets for you all if you fancy coming out to Silicon Valley. But if not, join us virtually for that. Thank you all once again. Stay safe, and we'll see you at the next Startup Grind London event. Be good.